How to get business credit with no personal guarantees. Did you know that 80% of entrepreneurs risk everything when starting a business? Like walking a financial tightrope without a safety net, founders often unknowingly pledge their homes, savings, and future earnings when applying for business funding. In this video, I'm going to show you a legitimate step-by-step system to build business credit while protecting your personal assets. Banks don't advertise these methods because they prefer keeping entrepreneurs personally liable. By the end of today, you'll know exactly how to create a barrier between your business and personal finances that traditional lenders hope you never discover. The hidden trap: personal guarantees in business financing. Have you ever wondered why banks are so eager to offer business loans to new entrepreneurs? The answer might shock you. Behind those friendly banker smiles and promises of business growth lies a calculated risk management strategy with one primary purpose: protecting the bank's interests, not yours. Most business owners don't realize that standard business financing comes with a dangerous hidden requirement: the personal guarantee. This legally binding document fundamentally compromises the protective barrier between your business and personal finances, essentially nullifying the corporate protections you established when forming your business entity. Now that you see how dangerous this hidden trap can be, let's explore why banks lean so heavily on this practice. The implications are severe. Like a financial double-edged sword, personal guarantees force business owners to pledge their homes, retirement accounts, and personal savings as collateral for business debt. If your business encounters difficulties, creditors can bypass your corporate shield and directly pursue your personal assets, effectively transferring lending risk from well-capitalized financial institutions to individual entrepreneurs. Financial data reveals the gravity of this situation. Approximately 80% of small business loans and credit cards require these guarantees. Yet most entrepreneurs sign without fully understanding what they're sacrificing. Many mistakenly believe personal guarantees are simply standard procedure with no viable alternatives. The banking industry has normalized this practice over decades, creating a one-sided arrangement that primarily benefits lenders. Banks enjoy the security of both business and personal assets, while entrepreneurs bear nearly all financial risk in an inherently volatile environment. This risk becomes particularly alarming when we examine business failure rates. According to the Bureau of Labor Statistics, approximately 20% of new businesses fail within their first year, and 50% don't survive past 5 years. Each closure potentially represents entrepreneurs facing personal financial devastation due to guarantees signed years earlier. The consequences extend far beyond losing business assets. Creditors can seize personal property, garnish wages, and damage credit scores for years. Many entrepreneurs have lost family homes and retirement savings due to business failures that should have remained contained within their corporate structure. Foundation building: creating a credit-worthy business entity. What if I told you that the most crucial decision you'll make for business credit independence happens before you ever apply for financing? The financial carnage caused by personal guarantees isn't inevitable. It's optional. Most entrepreneurs never discover that the structure of your business itself determines whether lenders can reach your personal assets, regardless of what lending documents you sign later. Creating a credit-worthy business entity begins with selecting the right legal structure. Corporations, particularly C corporations, provide substantially stronger separation between personal and business finances, compared to LLCs or sole proprietorships. This fundamental distinction is recognized by lenders when evaluating whether your business can stand on its own financial merits. Once you've established the proper entity, obtaining an employer identification number, or EIN, creates your first official separation barrier. This business social security number allows creditors to track your business's financial activity independently, establishing your company as a discrete financial entity. Documentation builds your business's legitimate identity. Business licenses, financial statements, and tax returns validate your operation as independent rather than merely an extension of personal finances. Registration with business credit bureaus creates another crucial separation layer. A DUNS number from Dun & Bradstreet forms the foundation of your business credit profile. Yet many entrepreneurs neglect this critical step entirely. Financial separation must be absolute. A dedicated business bank account using your EIN ensures that lenders see a distinct entity rather than an individual operating under a business name. This account becomes the central hub through which all business transactions should flow exclusively. Business identity markers, professional address, dedicated phone line, and business email domain significantly impact how creditors perceive your operation's legitimacy and permanence. As your business establishes credit relationships, your Dun & Bradstreet Paydex score becomes a critical metric, reflecting payment reliability and determining your eligibility for financing without personal guarantees. The Business Credit Ladder, from vendor accounts to bank financing. The Paydex score serves as the cornerstone of a methodical credit-building sequence that separates businesses that get rejected from those that secure 5- and 6-figure financing without personal guarantees. Most entrepreneurs don't realize there's a specific ladder of credit relationships you need to climb before approaching banks, and the sequence matters tremendously. Think of this ladder as your step-by-step pathway to financial freedom. The journey begins with vendor credit, the foundation of your business credit profile. Companies like Uline, Grainger, Quill, and S. Walter Packaging offer Net 30 accounts that report to business credit bureaus, establishing your credit history without personal guarantees. These vendors become your first creditors, significantly easier to qualify for than bank products. A common challenge here is choosing non-reporting vendors, wasting months of potential credit building. Aim to establish relationships with 5 to 8 reporting vendors within your first quarter. This initial phase requires patience and perfect payment history. After maintaining flawless payments for 3 to 6 months, your credit foundation becomes strong enough to graduate to the next rung. Store credit cards from retailers such as Office Depot, Staples, and Home Depot that further strengthen your profile. What's particularly strategic about the Paydex score is its weighted calculation. Higher dollar value invoices carry more significance. This creates an opportunity. Prioritize early payments on your highest value invoices to reach that crucial score of 80 more efficiently. After approximately 6 months of responsible store credit management, you're positioned for true business credit cards from American Express and Brex that maintain separation between business and personal finances. Banks want to see progression, looking for at least 1 to 2 years of history across multiple credit types before considering no guarantee financing. By following this strategic sequence, your business can qualify for credit lines between $50,000 and $100,000 without risking personal assets. For those seeking options sooner, the ramp card requires at least $75,000 in a business bank account, while the Bill Divvy corporate card may be available with just $20,000, both potentially without personal guarantees. Qualifying for no guarantee financing, meeting lender thresholds. Corporate cards offer a useful entry point, but the banking system operates on hidden qualification thresholds that determine whether your business finances stand completely on their own. Most entrepreneurs remain unaware of the specific benchmarks that separate businesses that qualify for no guarantee financing from those that don't. These aren't subjective criteria. They're measured in precise numbers across multiple distinct categories that lenders carefully track but rarely advertise. Qualifying for no guarantee financing requires meeting several key thresholds. Time in business. Traditional banks require a minimum 2-year operational history. Annual revenue. Traditional banks look for $250,000 plus. Alternative lenders consider $120,000 plus. Credit scores. Experian IntelliScore 70 plus. Equifax 90 plus. Paydex 80 plus. Banking stability. $10,000 plus average daily balance for at least 3 consecutive months. Many entrepreneurs describe crossing these thresholds as a watershed moment. When a business finally qualifies for its first non-guaranteed financing, it represents true financial independence. The moment your company stands on its own merits without requiring your personal assets as backup. Meeting these benchmarks represents an achievable milestone in your business growth journey. Each threshold you cross signals increased business maturity and creditworthiness to lenders, ultimately creating more financing options while keeping your personal finances protected. Before applying for no guarantee financing, prepare this essential documentation. Business bank statements, previous 3 to 6 months. Articles of incorporation. Cash flow statements. EIN documentation. The most accessible paths to no guarantee arrangements typically include business lines of credit, equipment financing, and invoice factoring. Each carries distinct qualification criteria depending on your specific business model and needs. Don't hesitate to shop around when seeking no guarantee financing. Different lenders maintain varying requirements, so rejection from one institution doesn't preclude acceptance from another. While guaranteed financing might offer slightly better interest rates, the protection of your personal assets typically outweighs modest interest savings for most business owners. We've come full circle on our journey to business credit independence. This isn't about finding loopholes. It's about methodically building your business's financial identity to create that crucial separation between personal and business finances. This separation delivers tangible benefits, better interest rates, favorable supplier terms, and enhanced creditworthiness. The pathway from establishing proper foundations to climbing the credit ladder has been proven by thousands of successful entrepreneurs. As Scott Allen, financial strategist at American Express with over 20 years of experience, explains, by strategically planning from the beginning, you can build solid business credit that helps eliminate the need for personal guarantees on business loans. Start implementing these steps today. Your dedication transforms financial risk into security that will benefit your business for years to come.